So yeah, we're just gonna start. Um, hey Joshua, thank you for joining. Thanks everyone for joining. Today we're gonna be talking about a real estate investment opportunity presented by Martin and Chris. It's actually a multi-family opportunity, and also there is also they're also going to talk a little bit about the rent to own opportunity and what it's all about. So yeah, I hope you guys gonna enjoy it. And if you have any questions, you can just post it in the chat, or just raise your hand, and we will have time to answer the questions.
Okay, thank you, Emmanuel. So before I share my screen, I'll just introduce myself and then let Chris introduce himself as well. So my name is Martine Aldrich. I'm actually, I'll give you a bit of background about me. I'm an accountant by training. I'm a CPA, so I have 20 years of experience working in a bank in financial reporting. So I've been in the banking industry for some time. And last year I formed a company called Martine & Co. Boutique, which is boutique real estate. Really with the goal of trying to help people with alternatives to getting into the real estate market. And I thought I would just use my passion for real estate as a way of helping people. So I personally have been investing in real estate for about 18 years now, and I have a lot of experience being a small scale landlord with smaller multifamily units. I've been the owner of a triplex and a fiveplex in the past, and now a duplex. And so I have a lot of experience, owning these types of properties, managing them, managing the tenants, who I call my clients, and also with doing renovations. So that's part of what brought me to this point where I'm doing this offering with Chris and working on this opportunity because I want to be able to share some of the success that I've had in real estate with others and help others get into real estate. Chris, do you want to just give us a little bit about yourself as well?
Sure, I can. Can you hear me okay?
Yeah, sound is good. Well, for me, it's good.
Yeah, we can hear you well.
Well, my career in real estate, I guess, started off as a hobby in, 1998, 1999. I read a lot of books, and then after that, I had a mentor, and I felt comfortable enough to get into my first investment property in 2000. And since then, I've gotten in and out of real estate transactions, various cities across southwestern Ontario. Kitchener, Cambridge, Waterloo, Hamilton, Burlington, Kingston. So I have a significant amount of experience with real estate on the residential side. And then after that, I decided to take a plethora of courses through different training programs, some national, some local, just so I can diversify and broaden my experience and skill set. I took about 3 or 4 courses, and then subsequent to that, I took it upon myself to start a real estate club, which really broadened my skill set because I'm surrounded by a lot of savvy investors. I ran that for about 4 years. I'd had meetings. The meeting sizes were anywhere between, well, my very first meeting was 3 people, and I was one of the 3, and that was really small. But at the apex, I got up to about 70 people, and that was the best meeting we had so far. And then after that, I got my mortgage license, and subsequent to that, I got my real estate license. So I've been a licensed mortgage agent since about 2008. I've been a licensed realtor since roughly 2015. And I like to learn all different aspects and facets of the real estate industry, whether it's mortgages or real estate investing. And then since then, I've partnered with Martine recently, and we're offering multifamily joint venture opportunities for anyone who might be interested or have the penchant for just looking at these larger type of assets. Yeah, that's what me in a nutshell.
Yeah, it's an amazing and very well-rounded experience. So that's part of why Chris and I got together. So Chris has been, in the real estate field, as you mentioned, for quite some time. And, we think with our combined skill sets where, I'm a CPA, he's been doing real estate for many, many years. And also with my personal background in multifamily investment, we think it's, creates a really good team. So I'm going to start to share my screen now. Just one moment. So hopefully you can see what's on screen. It should say multifamily offerings. Can everybody see that?
Yep.
Yeah, can see it.
Great. So I will start to run through now. So today we're talking about, as we mentioned, well, the first topic is multifamily investments. And, not everyone is familiar with this term, but just for those who don't know, multifamily can include investment properties of up to 4 residential units, which fall under a certain category. So that includes duplexes, triplexes, and fourplexes. So properties with 2 to 4 units, and these are typically classified as residential, really for lending purposes. And then, you can go all the way up to say 30 units and even more, and get into larger scale apartment buildings. But typically, 5 units or 5 doors and up will typically be considered commercial properties from a lending point of view. But they all have the same benefits, just to varying degrees. So multifamily is really a good option for diversifying and expanding your real estate portfolio. So, there's a couple of ways to go about it. So some people, like myself, this is actually how I had started out back in 2006, where I purchased a triplex, and it was at the time my principal residence, but I also had, so since it had 3 units, I had a tenant in the basement and also on the first floor, and I lived in what they call the owner-occupied unit on the 2nd and 3rd floor. And so the advantage of doing it this way is that the tenants, or clients, as I like to call them, they're providing rental income that helps you to pay your mortgage and other expenses related to the property, and just helps manage the costs of owning the building and helps build up your equity. And that's not necessarily for everybody, but the other way is really for people who want to diversify beyond their principal residence, or even for their first property, you can just simply purchase a multifamily investment without living in it. But definitely both allow you, and especially the second way allows you to achieve the economies of scale from owning multiple units. So the benefits of investing in multifamily properties are many. And this is an asset class that has done very well during the pandemic as compared with other asset classes. So most people are aware that, retail businesses have really been suffering as a result of everything that's been happening around us. And so commercial buildings or mixed-use buildings that have retail spaces, also the owners and landlords have been suffering to a certain extent. But the residential and multifamily type properties have really been doing well and have been seen as much lower risk, especially during the pandemic, or some people say pandemic proof. I mean, people always need a place to live, and so that's why residential has been safer. Vacancies have increased slightly, but still overall multifamily has been very safe. So another advantage is that there is less risk because you have multiple income streams coming in. So just as an example, if you have 2 units and one tenant or client decides to or is unable to continue to pay their rent, or for whatever reason the revenue stream from one unit is interrupted, you can rely on the other tenant client in the other unit to at least absorb some of the costs, and sometimes it's the bulk of the costs of that property. And that has been my personal experience. Currently, I do have a duplex, and I have had challenges during the pandemic. However, just the fact that I had more than one unit allowed for me to still generate income from the unit that was still providing revenue. So that's something to consider. And there is that higher cash flow for multiple units. The more units that you have, the better. It is passive income. You're earning it, even while you're at work, while you're sleeping, that income continues to come in, and there are the economies of scale. Again, the more units you have, the higher the cash flow tends to be on the property. And that helps to provide stable and reliable income. So just a little bit about who we think should engage our services. Basically, people who are looking to expand their real estate portfolio, but who don't necessarily have the time to research, everything about getting into multifamily, and who lack the time to do research on their purchases. We can help people like that. There are also people who may not have sufficient capital to purchase an entire property themselves, and that's where we can come in and help to create our joint venture partnerships. A lot of people who would need help, it really comes down to time. So for people who don't wish, or it's also desire, for people who don't wish to manage the renovations or manage the property themselves, or just don't have the time because of their busy lives, they're working and managing their families, that's where we can assist by saving time. So the way we can help is that we use our combined experience to provide a custom service for each client, and it will look different for each client depending on their needs. But with Chris's, as he mentioned, all of his experience in real estate and the fact that he's a realtor, he can access off-market properties. And now we're in a time where a lot of people are looking for multifamily properties, and it may take some time and it does require patience, but these types of opportunities can be found for people who are willing to continue their search. We can also assist with the financial analysis of the desired investment properties. And so again, that's where our combined experience comes in handy. So, myself being an accountant, I'm pretty handy with the numbers and the spreadsheets, and that combined with Chris's input and his experience allows for us to help you in a very, again, customized way and in a very hands-on way with analyzing properties that make sense. We can also help you with building your power team. So together, with the work that we've been doing, we do have a large number of contacts when it comes to real estate lawyers, property managers, and also contractors who can be called upon in case renovations are needed. And so we're happy to help our clients put together these power teams by providing options. And in any areas where we don't already have the contacts, we're happy to work for the client and develop those new contacts in new areas. But we already have a good list of power team members on hand to start with. And also we can help to guide you with structuring joint ventures. And Chris has found that some people who are interested in joint ventures already have their joint venture partners, whether it is family or friends or acquaintances, and others need help finding their joint venture partners, but we can assist with structuring those types of deals. And just a little bit about joint ventures, because there are many different ways to structure a joint venture, and it really depends on the skills and the experience that the partners bring to the table. But just a kind of a simplified view for those who aren't used to the concept. There's often what's called a money or a silent partner involved, and sometimes a working partner. So sometimes it's two individuals coming together to purchase a property. The silent partner could be also called like the capital partner, and that may be the person who's providing funding for the purchase, and that's their contribution, where they may provide the funds needed for a down payment, closing costs, and if renovations are needed, they may supply that capital as well, basically enough to close on the deal. Whereas the working partner is sometimes only providing his time, sometimes providing capital as well, but there are those who only provide their time and expertise, and that's their contribution to the partnership. And that's something that really shouldn't be overlooked, because often people who are investing, like as I mentioned before, they're just, their lives are busy and they don't have the amount of time required to go through the process of making the purchase, and then post-close, going through the process of stabilizing the property if needed, making sure the tenants are there, or managing renovations, whatever the particular property requires. It can take a great deal of time until you've stabilized the property. And so that's where the working partner is equally as valuable as the money or the silent partner. So for those who are looking for experienced working partners, we can also assist with that. So that's basically the gist of it on multifamily, short and sweet, because we also want to get into the rent to own. I'm just going to stop sharing for a moment so that Chris and I can both address any questions, if there are any.
Yeah, I have a first question for you, actually. So do you have an actual opportunity that you have on the market right now that you are working on? That people can, yeah.
No, because our process is that we typically start with the client.
Mm.
And so right now we're working with a couple of clients to find them their properties, but no, like the search is on for those clients. So we would start with the client first, and then because there's so many different needs, interests, or desires for an investment property, like the area could vary widely. We'll work in many areas across Ontario.
Mm.
So we start with the client first and then go from there.
Yeah, we want to do an optimized approach, and it's always better just to put everything in place. And then when an outright opportunity comes up, that we can capitalize on it. Because work on the property, then we have to find the partners. Then that opportunity might just slip through our fingers. So
Yeah.
it's better to just kind of be prepared, get all the financing ready, because that way, because sometimes you can put in like a clean offer. It also strengthens the offer as well if we have like an approval or pre-approval, and then we can go after the property. And the opportunities come up like every once in a while, some on market, some off market. So our main method of or main approach is to put the parties together, then wait to then look for the property.
Okay. And up to how many people can you take as partners?
Well, we can take as many as possible, but we like to kind of keep it small. So I would say no more than 6. And because we don't want to dilute the profits or the cash flow, as well as if you have too many people to make a decision on a property, then it just makes it has more confusion. It's
Yeah.
smaller. Like ultimately, it'd be better if it was just us, our entity, and then maybe 1 or 2 other people. But we'll make it like a little bit larger. But from a decision-making standpoint, and as well as profit standpoint, the smaller the better. Because when the most important thing when you're trying to put together a joint venture, different people have different financial objectives and personal objectives. And so without knowing that, you're adding so many variables that you might kind of like the project might just kind of collapse. So our approach is just to try to be smart as possible and with success being on the forefront. So we would like 2 or 3, but we'll probably go up to 6. However, we want to aim for as small as possible.
Okay. And usually, do you have an idea like of the price range for especially for multi-family properties?
Oh, well, the price range is really going to be contingent upon the financial aspect. So we have to look at like the mortgage as well as the strength of the borrower. So without knowing like how much of the capital injection and without knowing exactly how much they're qualified for, we won't really have a good idea as to what the price range is. But it all depends on the asset type, whether it's going to be like residential up to 4 units or commercial. But it could be anywhere from like 200,000 all the way up to like 3 to 4, maybe 5 million. But we don't want to go after those really large asset types. But so that's going to be contingent upon the joint venture partners, and after we know exactly what they will qualify for and the amount of the down payment, then we know exactly we can ascertain and hone in on the exact the price range. So unfortunately, all the aforementioned is pretty much antecedent to actually looking at the price range.
Okay. And also just to clarify, so the partnership usually works per opportunity or per deal, because like when you say six partners, that means next time you have another deal, you will need to add new six new partners, or you can work with the same one and add some more.
Oh yeah. Like the same partners, they can also start to invest into another project, or we can just look for new joint venture partners, because our investor pool is broad, and there are a lot of investors looking for the same assets. So if there's a good relationship there and it's profitable, then we'll give first opportunity to those investors who approach us first and we have a good relationship. We just all grow and kind of profit together. So there's a degree of flexibility, but it's going to be contingent upon like trust and past performance and everything.
Okay, perfect. Yeah, if anyone else has any question, you can just raise your hand or type them in the chat.
Yeah.
I don't see any questions, so I'm going to try to get through a little bit of the rent-to-own presentation. Is that okay, Emmanuel?
Yes, please.
Okay. I'm just going to try and share my screen again. Okay, so hopefully you all see that. So just because there isn't a lot of time, I'll just try and go straight to what it is about. If we are not able to get through all the slides, we're happy to have people follow up with us after the meeting and we can give more information. But basically, Chris...
Just a quick notice, your screen is not coming up yet.
Oh, sorry about that. I'm going to try again. And can you now see my screen?
Yes, thank you.
Okay, great. Okay, so a rent-to-own program is basically where someone is renting a home but working towards purchasing the property, and they have the option of purchasing at any time during their lease period. So in a way, you can say they control the property. And when you're in a contract with an investment buyer, the current owner, who we call the investment buyer, can't sell the home to anyone else since they're bound by an agreement or a contract to sell the home to the person renting is what we call the tenant buyer. So they have an agreement to sell the home to the tenant buyer at a predetermined price within an agreed upon time frame. And so the advantages of rent to own versus renting is really the main advantage is that, the plan is for the tenant buyer to become the owner of the property at the end of the term. And so another advantage is that they're considered the owner technically from the first day they move in, and they have more freedom than a typical tenant would to decorate and make changes to the house. And also the rent is a fixed market price, which is known and set as part of the contract until the time that the tenant buyer is able to exercise the option to purchase. So, just want to point out that this is actually a very safe rent-to-own program. The Canada Mortgage and Housing Corporation, CMHC, they do approve rent-to-own programs, which they also refer to as rent for equity. It's just another way of saying rent-to-own, where you're paying a portion of your rent that goes towards future equity. We together, Chris is actually, I have to give him the credit for creating this program, and he's been doing this for many, many years. And we wanted to come together and just kind of expand on people's awareness of the program and offer it to many people in the community and make sure that people in the community are aware of it as well as an option, as an alternative. So Chris had built in, and what makes the program very safe is that he's built in a rigorous review of the applicants prior to them being approved for the program. And we try to ensure that the tenant buyer will qualify for their own mortgage before the contract ends, to make sure that, we don't want to have the situation where someone comes to the end of the contract, and that could be 3 or 4, sometimes it's longer at 5 years in, and then learn that, it's not going to work out, that they're not able to purchase the home. So we do that upfront pre-qualification to make sure that we're accepting people into the program with a very high likelihood of success. So during the contract period, we also work with tenants to, where it's needed, not every tenant buyer needs this, but for those who need to work on their credit and are doing credit repair, we will check on them every 3 to 6 months, depending on what's appropriate for that particular client, to help them keep on track with their credit repair. And, you know, before the contract is signed up front, also just want to point out that we encourage people to seek out their own independent legal advice just to ensure it. And that's one way of ensuring that you're entering into a safe contract with a high likelihood of success. So rent-to-own programs are typically for people who are not able to qualify for a traditional mortgage to purchase a home. And so this may be appealing to people who have damaged credit, but they just need time to work on doing the repair needed to get their credit rating back up. It's also for people who may have been working towards saving for their down payment, but who don't yet have the full amount. And also self-employed individuals sometimes have challenges in qualifying for a traditional mortgage. And so this program can sometimes help individuals like that as well. Another thing I should point out is just really that what we're finding now, especially with the increase in prices, you know, that we've been seeing for many years, that flexibility is also important. And what I mean by that is just for people who are likely to be interested in Toronto and even sometimes often the GTA, or anywhere where, you know, the prices are higher, it may not work. Something that we ask people to keep in mind is that we look at an income multiple just as like a first pre-screening check, and people will typically qualify for homes that are, say, between 4, sometimes 5, but you know, 4 is a good starting point to be conservative, 4 times their household salary. So it's just something to keep in mind, and that's where, you know, flexibility on area becomes important, as that will limit the areas that someone can search. So I'm trying to watch the time as I talk. I can see we're coming up to 7, so maybe I'll just go through one more slide before I pause for questions. But basically the way it works, like for someone who enters a rent-to-own program, is that during the rental period and during that contract period that they've entered into with the investor buyer, you can look at it as the tenant buyer is paying kind of 2 rents. Like one is really the market rent that is appropriate for that home and for that area. And then on top of that, they're also paying an option premium, which is the portion that is going towards their building up their equity and going towards the future down payment that would be used at the time that they exercise their option to purchase. So I guess I won't get through the other slides. I think I'll just pause for questions. I'm going to stop sharing my screen so I can actually see if there's any questions.
Yeah, for the rent to own, is there actually an opportunity for investors?
Yes, there is, and yes, we do look for the investor buyers. I'll let Chris speak to that side of it.
Oh no, you're fine. You can go ahead and talking about it.
It's just that the investor buyers are the people who actually would purchase the home on behalf of the tenant buyers at the beginning of the contract.
Okay. And isn't there any risk for the investor, like when they're taking the option premium, so they're like liable of being able to give the right to the buyer of that house, regardless of the market price at the time of the option expiration?
The risk is kind of limited because they actually own the home. So if there is any kind of risk, that's built into the contract. So the only thing with contracts is you just try to be as proactive as possible to ascertain everything that could be possibly go wrong, and then we try to work out amicable solutions and just build that into the contract. So we try to think about anything that has gone wrong in the past, and then just try to make sure that it's mitigated. So the most important thing with any rent-to-own contract that's often overlooked is a good rent-to-own contract is intended to be designed to protect the investor as well as to protect the tenant buyer, not just one side. With some individuals, it's tend to be like just protect the investor, but we try to make sure that the tenant buyer is protected as well. So to answer your question, yeah, we take that into consideration to make sure that they're protected. So anything that could possibly go wrong, we just try to anticipate that and then try to draft conditions and terms inside of the contracts to be able to make sure that it's mitigated or if not, eliminated.
Okay. And Monica just asked you, for the buyer, what risk do they take if they change their mind and decide not to buy at the end of the contract?
The tenant buyer?
Yeah.
Yeah, the tenant buyer, it all depends on the reason why they're not buying. If they just simply decide to change their mind, then it's kind of like, well, if you get a mortgage through a bank and you decide just to, stop making payments, then there still has to be some kind of penalty. So uh, you have to make sure that you're serious, and so it's a very careful vetting process to find out why do you want to buy the home, why do you want to buy that area, how stable is your situation. So we try to ask as many questions up front, such that that question down the road doesn't come up. Like, okay, well, I don't want to buy. Well, why not? Your income is stable. You want the home. There's a justifiable reason. But if it is a justifiable reason, then one of the possible solutions is to just sell the property and then just a portion of that down payment to go back to the tenant buyer, as well as in the split an amicable solution with the tenant buyer and the investor. So it has to be fair, but at the same time, when you get into a contract with someone, you're pretty much obligated to fulfill the terms and conditions of that contract. Like if you go to buy a car, like will the car dealership just allow you just to walk away? So it's if you decide to get a contract with a builder, you walk away. So all contracts are designed to protect both parties, and the one, and especially the party that decides to change their mind at the end, there has to be some kind of penalties for that, and that's kind of standard built into all the contracts. So only thing we can do is explain to them what the risks are, what the penalties are, and just to make sure that they're certain that they're making a good decision, as well as to seek independent legal advice as well, just to make sure that they know the repercussions of their decisions. But once again, it is a contract, and if they do decide to change their mind at the end, they're actually causing it. They could cause irreparable harm to the investor because they just sometimes they're not flush with cash. Sometimes they borrow the money, use their line of credit, take a second mortgage on their home. So that's their family as well. So there's two sides to the story. So, but hopefully that answers the question.
Yeah, okay. Yeah, it's pretty clear actually. And just to clarify, wouldn't that forfeit their premium payment of the auction?
Oh, sorry?
Wouldn't that make them lose like the portion of their rent that is toward the auction?
A portion, but we try not to make it too onerous. But it all depends on what the reason is. If it's a good reason, then we try to work with them. We fervently believe that you can't predict what's going to happen in the future, but all you can do is control what the solution is. So if there's a solution that fits both sides, then that's the only thing that we can really do, because no investment, whether it's stocks, options, or real estate, or anything you do in life, is predictable down the road. But all we can do is try to foresee as many of these possible issues as possible, and then just try to build in contingencies that protect everyone, because there's no guarantees. Tenant buyer might die in a week. Investor might die in a month. All we can do is really foresee as much as possible. But yeah, there are no crystal balls out there. There are, then I'll put in my order for a couple.
Hopefully not. And I would just add, thanks, Chris, and I would just add that it is part of the CMHC guidelines that a portion, as Chris mentioned, a portion of the option premium that it is returned.
Okay.
If the option is not exercised.
Okay. And last question, Nora asked what is the actual incentive for the owner for proceeding with a rent-to-own contract rather than selling their property right away if they have a buyer and stuff.
Oh, do you mind if I take that one?
Go ahead.
There's two different types of rent-to-own scenarios. There's a tenant first and there's a property first. She's actually referring to a property first. And the only reason why an owner of a property would elect to employ a rent-to-own strategy to have a tenant move in there is if they couldn't get the sale price, or if there are no offers on their property and they have to move. And we don't know their exact motivation for moving. However, sometimes that is the perfect solution. Home sellers have like a lot of different options, but sometimes there's only really one optimal solution. So, and if that's an optimal solution, they'll employ it for many different reasons. It could be tax purposes, it could be opportunity, it could be just lack of interest or offers. So, but bottom line is we don't really know the impetus for that particular home seller. We just know that to them that is the perfect solution, and sometimes that's something I just want to go with.
Okay. Perfect. Thank you very much again, guys. Thank you, Martin and Chris, for this. I think it's a really amazing opportunity, the rent-to-own as well as the multifamily investment. It's yeah, I really appreciate your time, and I see the potential in these opportunities. So, guys, if anyone is interested and want to know more and to get involved, you can reach out directly to Martine, and I just shared her website as well. Yeah, so you can go to the website, you can contact her, and yeah. Thanks, everyone. If you have any questions too, you can reach out. I think you're in our group, right, Martine?
I am, yes. So people can contact me through the group conversation. I can also just type my email address into the chat if it helps, or maybe write it down. You would also find it on the website, but I'll just put it there in case it helps anyone.
Perfect.
So yeah, thanks for having us both, and hearing from people about with their questions. So thank you.
Awesome. Thanks again for your time, guys. All right. Thank you, everyone, for coming, and have a great rest of the day.
Okay. Take care. Bye. Bye.
Bye.